Meet Sylvia Ho, a lawyer who's got the legal info that business people need to know.
Hello, everyone. Welcome to my office. And today we're going to have a really good treat for business owners because we're going to discuss choice of entities for anyone who's going to start a business or for experienced business people who formed the wrong entity. Today we have Matt Tarini, who is a CPA, and we're going to cover all sorts of corporate entities and what effect they have on the money that you spend in taxes and how they expose you to different liabilities or maybe protect you from them. So welcome, Matt.
Welcome. Thank you, Sylvia. Great to be here.
So Matt has been a CPA for 24 years. That's a long time. And I've practiced for a long time too. So with that comes wisdom. And so what we're going to do is we're going to open up a chart that we have so that people can understand all the different corporate entities that exist. So Matt is with MNT, which is an accounting firm in Connecticut, in Manchester. And so Matt, let's talk about choices of corporate forms here. And we're going to use this as this graph here as a jumping off point. And let's talk about sole proprietors and partnerships from the perspective of anyone who's starting a business. So I start a business and say, I want to start it cheaply. I hang up my shingle. I record a name. I don't record it anywhere. So that's pretty much considered a sole proprietorship. Is that right?
Yep. And you know, the great thing of sole proprietors, right? It's the easiest thing to do, right? If you have a super small business, and I use some of the examples of like, I go to my flea market and, I go sell $20,000 of business a year, or I do some of these door-to-door sales. I'm not doing door-to-door sales anymore, but some of these virtual sales where you're selling product and you're getting some product. It's an easy opportunity for people to get in. They've set up a sole proprietor, right? There's, as you know, right, from your side of the aisle, there's not a lot of cost to it, right? And when you're doing smaller dollars, they're probably the easiest way to get into doing some business and be able to report that to the IRS, right? Because at the end of the day, this is what ends up happening, right? These sole proprietors, they have to report. Half the times don't even know they need to report until they get a 1099 at the end of the year saying, oh, what do I have to do with this? And they end up calling someone like me saying, hey, I've gotten this form. I've never done this before. What do I do? So really, it's an easy entry point for people to get into filing taxes for self-employment. But as you know, Sylvia, being the sole proprietor can lead to some issues from the legal side of legal protection and stuff like that.
That's right. So we see a lot of sole proprietors as solopreneurs. We call them solopreneurs, and they might be a dog walker or someone who's providing a service-based business. They might also be someone who's involved in multi-level marketing. And in that way, what would they get a 1099, which they would report on their personal income. But if you're a dog walker or if you find some sort of service, you leave yourself exposed to personal liability because there you are. Sylvia Ho is creating a business, and let's say Sylvia Ho's dog walking business. Sylvia Ho's dog walking business is Sylvia Ho. It's not anything else, right? And if you want to register that business and use the trade name as, dog lovers, dog walking business, you would go down to your local clerk's office in your local town and register yourself under the trade name. It's not a trademark. Just make clear, trade name is a name by which you do business as in another name, but you're still personally exposed. So we move over to the partnership or a joint venture. So a partnership are two people, and I put joint venture in there because a joint venture may be two businesses that come together for a specific purpose to do a business. And so again, we're talking about two people. So it would be Matt and Sylvia. Matt and Sylvia doing business as dog lovers dog walk business. So we might register our dog walkers business, say in Manchester, where Matt is, and in Farmington, where Sylvia is. So we can do business in these two towns under dog lovers dog walk business, but it's still Matt and Sylvia, right? Is
Right.
that right,
Yep.
Matt?
Yep. And the important part with that is when you think about it, the kind of examples we're giving are right businesses that are in a trader business to make money, right? So that's going to be important as we get further down the road with some of these other structures that we're going to talk about. But the reality is, if I'm a sole proprietor or a joint venture, or just Sylvia and I are just a plain old partnership, right? Forgetting LLCs for now, right? We're just a general partnership. All of this income is taxed subject to self-employment tax, right? Which is built of FICA and Medicare, right? And I'm sure people out there know loosely what these things are, but it's important to know for every dollar you earn net, right, you're going to pay income tax and Social Security tax and the Medicare tax, right? So self-employment income tax gets paid, right? So the big issue for me is actually a relatively simple one. It's subject to it for $0 to $1 million, right? You're paying Medicare forever, and Social Security stops depending on, right, what the current tax law. It's like 137.7, I believe, off the top of my head. So that's the important part. But I think, Sylvia, as you and I are talking about with these sole proprietors and joint venture / partnerships, right, you're leaving yourself open to some legal issues there. You can correct me if I'm wrong.
Right, that's right. And so if Matt and I got into an argument with each other, so this is a government document about how we do things. So if you're a sole proprietor, you're in business with yourself. So if you get into an argument, you need to go see a therapist. But in the case of a partnership agreement, that's going to determine how we resolve our relationship problems. So we get into an argument, we go back into the partnership agreement in our joint venture. And if we don't have one, I'm sorry, it's going to be very expensive in court, and it's going to really impede on your ability to move forward in business. So it's not a preferred form unless you have a partnership agreement. It's not the preferred form unless you're two businesses that are going into a joint venture and you already have those tax protections, right, Matt?
Yes, right. And that's the important part, right? At the end of the day, it's how the money comes in and how we're packaging. And that's what are going to dictate how we pay our tax to the government, right? And so again, a lot of times, and especially with the tax law change, a couple of years ago, there was much more of a tax penalty, if you were. The bigger you grew with sole proprietors or partnerships, it's kind of shrunk a little bit now. We're going to talk a little bit as we get into some of the other entities, but again, and with the potential new tax law changes coming out, maybe 2022, there might be a shift back from some of these. So we're going to talk a little bit about that, but I think you're right, Sylvia. The end result is it's how we package it and what our entity is from a legal standpoint is how I get it from my standpoint, and then tell the government, hey, here's where we're at and here's what we have to pay in tax.
Very important issues once you get to be more than one person, because when you get more than one person, especially if you get them more than two people, you have different ideas about things, and then you pretty much have to agree on things, and you have to figure out how to resolve things, and then you have to be really aware of what the tax ramifications of what you're doing to you. So you really want to be able to plan properly, have good bookkeeping, good records, and even when you're resolving a dispute, having a good record will save you a lot of attorney's fees in the end. So what we're going to do now is we're going to jump ahead over here. See, my hand is going to be on the C Corp. The reason why we're going to go to the C Corp, you're going to see in a minute, because that is not a usual form for small business. And right now, my clients are small businesses, and so are Matt. So let's talk about the C Corp. In the C Corp, you form a corporation. So if you're in Connecticut or Massachusetts, you would go to the Secretary of the Commonwealth, the Secretary of State's office. Matt and I both practice in both jurisdictions, and Matt even more because Matt's not limited by a license where I am. And so the governing document for corporations is corporate bylaws, and it's a very formal type of system. And so before we jumped on this call, we talked about how if you're a corporation, you're running by the same rules as Amazon or any large company. And you might be just you and a bunch of other people in a small place, but you should think about that when you're forming a company. What is the reason for it? And so, Matt, corporations, C Corps, they're known as double taxed
Yes.
companies, right?
Yep. And I will say, we do, if you look at our book of business, right, C Corps make up a very small percentage, right? And I will tell you, the reason why we still have some is a lot of these companies have passed generation and generation. They were set up such a long time ago that the companies decided to keep that C Corp status when there weren't a lot of these other entities out there, right, Sylvia? So when you think about that, right, those are some of the things that we see coming down the pike is, hey, we've got the C Corp, and you look at it, it was incorporated in the 60s or the 50s, right? And it's been generation to generation. So the problem, as you eloquently noted there, is, right, C corporations, I have my salary, I take my money out. The difference between C corporations versus all these other ones we're going to talk about, they actually are their own, on top of their own living, breathing entity. They pay tax at the C corporation level, right? So what happens is, let's say Sylvia and I are owners of a C corporation. We each take out a salary, let's say of $100,000. And after we pay all of our income and expenses, et cetera, et cetera, et cetera, on top of our salaries, there's still a profit of, let's say, another $100,000, right? Well, corporations pay currently, right, under the current tax laws, a flat 21% on that, right? So of that 100,000, the corporation then pays tax 21,000 to the Fed. And of course, if it's Connecticut, right, they have their own tax bracket. It's like 7.5%, right? Massachusetts has its own corporate tax numbers. So that's where, so, well, if I don't want to pay at the corporate level, I want to get it out. Okay, well, if I get it out and I don't take it through salary, right, there's some other ways, like taking a dividend to try to get into a lower tax bracket. That's, again, the current tax law states. So we can take dividends out of there. Okay, so if we have that same 100,000 in profit, and then let's say the next year, okay, we want to take that 100,000 out. I've already paid tax on it at 21%. Now I got to take it out of the dividend at, right, depending on what tax bracket I'm in, right, 15, 20%, right? You can see how if you're adding, right, my tax bracket, the corporate tax bracket, and the dividends, right, the numbers add up pretty quickly, right? So C Corps are something that very rarely get used. I will say I do have a client that's considering it. I think this is probably one of the most pertinent examples for under today's current tax laws, why you would consider a C corporation, right? Their goal was to sell their company in a 5-year window, right? So they're going to take advantage of this special, there's a special, and I don't remember the tax code off, I think it's code section 83B, right? But there's a way where you can set up a corporation, get it valued, and then the gain from today to where you go public, that gain can theoretically get wiped out if you make these special tax elections, right? So it would probably be one of the few reasons today why you would see someone do a C corporation.
Yeah, and you really should have a good strategic plan for that, because you can make elections and change your corporate form, and be aware that if you're a company that's a growth company and you have an investor buy your assets in your corporation, they might not really care whether you're C Corp. They might just want to buy your assets, or they might say, well, let's form a new C Corp.
Right.
So you don't want to be wasting all that money from the beginning in your taxes, only to find out that you're going to have to form another C Corp later. And
Right.
that is quite a common issue. I spoke to someone who said, hey, I like to form a Delaware corporation because eventually I will sell this. And we had this conversation. This was an entrepreneur who had already exited a couple of different times. And I reminded him about whether or not he started the other companies as C Corps. And he did start one with a C Corp, and he started another one with an LLC that became an S Corp. And he said, when they came along, they said, nah, let's just form a new corporation and then take your trademark, your goodwill with us, and then we'll issue you some shares. So just imagine all that money that you could have been saving in taxes all along. So that's something to be aware of. So I'm going to jump back to LLPs, which is something that is a form in Connecticut, and it's called a limited liability partnership, and it's governed by a partnership agreement with limited. I put this operating agreement, and it's kind of similar, but it is a partnership agreement, and they have limited partners and general partners. And I wanted to cover this because we need to get out of the way and get to the two most important forms, which are LLCs and S Corp. So what I have to say about that is to look at your liability as a limited liability. So your limited partners will be protected from liability, and the statutes provide that. But if you get into an argument, you still need to have an agreement between each other about how you're going to resolve it, or you're going to end up in court. And then again, for taxation purposes, Matt, it's the same as a partnership. Is that right?
Yep. And it's funny, Sylvia, you say that because I'm not even sure if we do one or two out of all of our partnerships. We have a decent amount. I think we maybe do one, right? It seems like it was something that was popular before, like you said, before LLCs came into place. LLPs were kind of one of the hot topics, but from a tax standpoint, in the last 15 years, I can't remember ever seeing someone set one of those up recently. But you're right, they are taxed essentially the same way.
So we're recording this in 2021, at the beginning of 2021, and looking at the Connecticut Secretary of State's office, there were fewer LLPs that were formed. In fact, there have been a drop in LLPs year over year in favor of the LLC. So what we're going to do now is we're going to talk about LLCs, limited liability companies, which are the most popular forms, and then S Corps, and compare the two, because that is where most business owners are have the most questions. So an LLC is a limited liability company. It's a creature of statute. It came about in the early 90s, which has been a long time now, and it exists in every state, and it's governed by an operating agreement. And oftentimes, people who form companies will opt to have an LLC over being a sole proprietor, because they just hear about it and they think that they can protect themselves from liability. So they go ahead and hire one of the unnamed online services, because I cannot mention those that cannot be mentioned. And then they forget about what it is that governs their operating. So they don't do an operating agreement. And this is particularly an issue with an LLC with multi-members, because if you don't have an operating agreement, it falls back to the statute about what your rights are. And then, of course, you're going to find yourself going to court. If you have an operating agreement, you're going to find yourself having a discussion of what happens if one of you dies or gets hurt or needs to sell. So a lot of things can be determined in the operating agreement from the beginning, and it is a really good form if you have an operating agreement. And just beware, if you use these online services, they're charging you money for something that you can do yourself by going to the Secretary of State's office and filing it yourself. And you can be, as an officer of the company, served with a lawsuit. You don't need an agent for service to be having an agent for services, paying for that is fine. But it also allows, it doesn't prevent someone from serving you at your home as an officer of the company. So that's just clear information that a lot of business owners don't know about. So we're going to get to taxation, Matt. So what do we have to say about this entity regarding taxation?
I want to ask you a question before we get to taxation, because I've seen this issue come up funny from the accounting side of what is your thought on, let's say it's a real estate company and we have to have a cash call from its members of the LLC, but the membership agreement is silent to that. I see this happen a couple of times. Can you, I want you to talk about it because I kind of seen what happened over in the past, but what's your thought on, right, capital accounts like that, where if you need to draw from people and say, well, I don't want to contribute, right? You and I own a piece of real estate. Hey, our tenant left, right? It's a tough year with COVID, et cetera, et cetera, et cetera. We have to put in $10,000, and somebody says, oh, I'm not putting in 10,000. You put in the money. I'm not.
Right.
I'd love for you to talk about that.
Yeah, well, I think that has to do with the operating agreement, right? The statute will not talk about that. The statute will talk about if you have an argument. So not having a well-drafted operating agreement gets you into a disagreement. And if it's silent, then there's all sorts of accusations. Of course, you can always agree, but if you don't agree, you fall into the operating agreement. If you don't cover that in the operating agreement and it's silent on that, then you get into a disagreement. So a well-drafted operating agreement will also determine how you resolve your differences. So a very common way of resolving differences is to go to an arbitrator or a mediator. And you can add those into your operating agreement. And a well-drafted operating agreement will cover capital accounts, especially when you are in a particular business. So you want to be having that conversation with your business attorney, planning for that eventuality. You don't, you hope for the best and you plan for the worst. Right. And if you plan for the worst and you haven't covered it and you agree that the two of you or three of you or four of you cannot agree that you're going to go to a certain membership organization with an arbitrator or a mediator, then you've saved yourself a lot of legal fees. And because that person that the LLC hires will try to address all these issues. Now, one of the biggest disincentives for disagreements is the cost associated with it. Right? So if you know it didn't cover and you're arguing, but you have to go hire this third person to resolve it, you're going to say, hey, it's going to cost me X. It's going to cost the company, this, Y. And so Y minus X, let's see if we can work it out ourselves. So that would be kind of a technique in a operating agreement as well.
That's awesome. I just wanted to ask, like I said, I've seen it happen a couple of times. And like you said, they spend more in legal fees to fix it, way more than they would to draft a very good, like you said, a good operating agreement.
Yeah. And I think that's, I come from the litigation side of things for years, and I see everything that could go wrong. And really, part of my frustration is to explain to someone that it could go wrong, because when, it's like, on your wedding day, you don't want to think about possibly having a prenup, right?
Prenup,
and that's really what an operating agreement is, so.
That is true. That's true.
Go ahead.
So that's okay. So let's spin this forward to tax, right? LLCs, right? As Sylvia mentioned, and we were chatting before we came on the air today, that there was 44,000 LLCs set up in Connecticut in the last calendar year, which is a huge number, right?
2020 in a pandemic.
Yes. Right. So, and again, part of it, as we were talking about it before, was that it's an easy legal agreement, easy legal entity to get into. It's relatively easy to get out of, I believe, again, with the proper documentation done ahead of time. So let's speak about that now from the tax standpoint, because I can tell you almost every new client that walks in my door says, hey, I set up a company. I'm like, what are you? I'm an LLC. And it doesn't matter what they're doing for business. They're all LLCs, right? So I'm going to give you a little bit of background. LLCs are a legal entity, not a tax identity in the IRS's eyes, right? It's a very important note to make. Why?
Creature of state law.
Correct. So now let's fast forward. So the LLC can elect to be taxed as a sole proprietor, in essence.
Right.
I'm going to just use the easier terms.
Right.
It can be taxed as a partnership. It can be taxed as an S corporation, or it can be taxed as a C corporation, right? So it's just a legal vehicle to set up, and then you kind of figure out which way we want to tax ourselves, right? So I will say this: LLCs are awesome for holding a piece of real estate. Passive income is great for LLCs. Why? Because passive income is not subject to self-employment per the IRS rules in the first place. So if I own a piece of real estate, let's say it's 160 Chapel Road here in Manchester, Connecticut, where my office is located, right? My income is never subject to those payroll tax. So I'm saving, right, conceptually 15.3%. Awesome. Great vehicle for real estate. Highly recommend it, right? From the tax side, and Sylvia can preach the legal side. It's kind of one of those no-brainers, honestly.
It's a very commonly used technique. You can just bring it all down to your tax. You're not being taxed. It's very elegantly done, and real estate developers do that all the time.
All the time, absolutely.
Yes.
So here's the good part. Now let's kind of zoom into the business side of things, right? So I have a business, right? I'm an accounting firm. So, okay, now I have an LLC and myself and my 3 partners here. Okay, great. So the general gist is no different than a sole proprietor, whatever my piece of the pie is, right? Let's go back to, let's just say it's Sylvia and me. There's 2 of us, right? We have a
dog walking service.
right.
Yeah.
It's perfect, right? So we make money. We make $200,000, right? Sylvia picks up 100. We're even owners. Sylvia picks up 100. I pick up 100, right? So it's no different than the previous scenario. We're taxed on 100,000 for income tax, Social Security, and Medicare all the way through. Perfect, right? There's nothing conceptually wrong with that. If I'm elected to be taxed as a partnership where it's Sylvia and me, or if I'm the sole owner of the LLC that has a dog walking service, right? All of that income is flowing to me. That doesn't change if I'm taxed as a sole proprietor or a partnership, right? All subject to self-employment tax, right? So,
Right.
Go ahead, Sylvia. Sorry.
I said right.
Oh, okay. That's good to know. So I think the scenario is that we talk about these things is a lot of times, right? These have been set up before your income ever varies or the tax law changes, right? I mean, if you look right here in 2021, the tax law that was changed 3 or 4 years ago was the biggest tax law change since 1986. That's how big the tax structure shifted. A huge shift for accountants, right? Accountants who love stability basically had to go back and sit in classes for a long, long time to say, okay, what do I do then? Because what I used to do then maybe not be the best way now. So if you're ever going to get one big takeaway from this is forgetting what you were 3 or 4 or 5 years ago, you need to kind of look at your structure, right? And this is part of the reason why Sylvia and I are having this discussion today. Right. It's important to say, hey, it's no different than a will. I set up a will 20 years ago, but those estate rules have changed so much. I still might have a will, but it might not be the best thing 20 years ago. So taking a peek at what your tax structure is important to do as the tax law changes, right? And again, like Sylvia said, it's February 12th, 2021. There's going to be a big tax law change coming up. My guess is in 2022, where again, this might shift this, what we're just doing now, it might shift it again. But as we always do, you have to play by what the rules are today. So this is kind of what we're talking about. So I just think it's important to know LLCs, whether I'm taxed as a partnership or a sole proprietor, every nickel you earn is subject to Social Security, income tax, and then when you cross over the Medicare threshold, it shuts off.
Every single penny you personally earn.
Yes.
So
yes.
So that's really where we need to think about a disregarded entity as far as being taxed as a sole proprietorship or a partnership.
Right.
So we're going to switch over a little bit to S Corp because some people are interested in forming S Corps and S and C, they're part of the Internal Revenue Code. So they're described by size of business, not necessarily by their legal format. So just as S Corp, C Corp, for legal corporate purposes, Your Amazon, I'm sorry to say, you don't earn as much income, but you still have to observe the same formalities.
Right.
So,
And that's a great point, Sylvia. That's a great point, right? Because I don't think people quite conceptually get that thought.
right, that it's part of the Internal Revenue Code.
Yep.
And it is done preferentially for small businesses as defined by the code.
Yep.
And in terms of what your income is, how many employees that you employ, and based on that, you're taxed differently. So that's a difference between S Corp and a C Corp. So now we're looking at corporate bylaws, same idea. You should have corporate bylaws. That is a governing document. Whereas an operating agreement and an LP document talks about the relationship between the members, usually active in their business. And sometimes you can have silent partners in real estate where they have their money in, but they're not operating it. They're not general partners, or they're not managing members as in the terms of LLCs. In S Corps, you have boards of directors, and you have officers of the company, and they run the company. And you have shareholders. You have to have annual shareholder meetings, and it gives the officers and directors certain amount of leeway to make decisions, but otherwise you still have to go back to the shareholders to have a shareholder vote. Now, you can imagine why so many companies start out as LLCs, because you don't want to have your annual meeting. And what is the consequences for failure to observe your corporate formalities? If someone sues you, they may claim that your company doesn't follow all of the corporate formalities, and therefore it's a sham. It's actually you, and we can sue you personally. So you should be aware of that when forming a corporation, that it's important to have all of those corporate formalities followed. And now to the tax.
Well, the beauty of, and again, I will say the beauty of LLCs and S corporations combined is the concept is, unlike C corporations, there is no double taxation, right? The LLC and the S corp does not pay federal tax at the entity level. It flows through to Sylvia and myself and to you, right? So I think that's one of the bigger things to point out. Now, in Connecticut, I'll specifically speak to Connecticut, right? They pass this pass-through entity tax because of the state and local income tax limitations that they put on at the federal level 2 or 3 years ago. Connecticut, because we happen to be a heavier tax state, said, hey, wait a minute, since you're not being able to have the deductibility of the taxes you pay to Connecticut, they kind of allowed LLCs as partnerships and S corps to pay this tax to get some kind of federal benefit. So generally speaking, though, most of the tax on your LLC or S corp is paid individually. The state is paid through the partnership or the S corporation. So that's one little neat caveat that's happened, right? So S corps, why are they popular? Well, I'll give you two major reasons. Pre the major tax code changes of 3 or 4 years ago, I would tell you any business that was making probably more than $100,000 would have benefited from being an S corporation, right? Because the loophole in the law from way back in the 50s, I believe, way before my time, I hope, was that S corporations, right, on top of getting a W-2, you also get a K-1. So let's just go back a little bit. LLCs, taxes, partnerships, same, Sylvia and I are partners, 100,000. That comes on a K-1, not a W-2. So I should have probably gone a little more detail here, right? So
Right.
Sylvia gets a K-1, right? Matt gets a K-1.
1065,
yes.
issue the K-1s.
Yep. So that money on your K-1 is then subject to Social Security, et cetera, et cetera, et cetera. Okay, let's fast forward to S corporations, right? Let's do the same scenario. Let's say there's the same $200,000 profit. Well, Sylvia and I, we're going to leverage the S corporation to its full tax benefit. Now, I'm not going to talk about Social Security earnings, or I'm going to talk strictly from an income tax basis. I'm not going to talk about retirement plan contributions because those are all competing things, but let's just talk purely income tax. So on this $200,000, I'm going to say, hey, Sylvia, here's what we're going to do. You're going to take a salary of $70,000. I'm going to take a salary of $70,000. Okay, great. So that's 140 of my $200,000 profit we've taken out as wages. Okay, great. So that leaves $60,000 left over. So S corporations also issue a K1. So again, Sylvia and I are going to split that K1 in half. She's going to get a K1 for 30. I'm going to get a K1 for 30. So in essence, it's still the same 100. It's still the same. We each have 100,000 on our 1040 to report, right? Just in two different buckets. Here's the big tax planning savings tip here. If I did that scenario, right, the $30,000 K1 that Sylvia receives and I receives are free of the payroll tax. There's no Social Security or Medicare on that 30,000, right? So if you think about that mathematically, right, 7.65% on 30,000, right, it's really 15.3 because you're paying the employee and the employer side, right? So if you take 15% of 30, I mean, 10% is 3, it has $4,500 roughly we've each saved in payroll taxes, versus being the same tax, versus being a structure of a partnership, an LLC, where it's all taxable every dollar on that. So that was the pre-tax code change from 3 or 4 years ago, right? What happened was, as part of the change in the tax code, they had this 20% deduction on K1 income that you can now take on your 1040. Well, let's go back to the same scenario. On the S corporation, right? Sylvia and I only have a $30,000 K1. On a partnership, we have a $100,000 K1, right? So if I'm taking that 20% tax saving that they put in the code, right, there are levels of where there is a crisscross in what the benefits are. And that's what I went to when I was talking about it before. This tax structure needs to be addressed, right? Because as every time the tax law changes, you can shift, right? I can become an LLC taxed as an S corp. I can then shift out of that, right? And excuse me, maybe decide to become taxed as a partnership. There are some ways, and you have to finagle the code a little bit, but it would behoove you to consider, how am I taxed? How are the rules in place now? And what are my income levels? One of the biggest dictator of this is, what's my income level? If I'm making $10,000, again, on a small business, right? If I'm doing a multi-level marketing business, right? If I'm making $10,000 to $15,000, there's probably no real discussion to be had, because the numbers are inconsequential, right? For what the savings are to additional, maybe some additional accounting fees for filing some of the different structures. But as the numbers get bigger, the potential for savings gets bigger. And obviously there's softwares that we use to say, and I've had a client where I say, listen, I'm going to make, 50,000 this year, 100,000 this year, 150,000 in year 3, and 200,000 in year 4, right? So maybe the concept is, well, maybe we stay an LLC tax as a partnership for the first 2 years, and then maybe we make the jump to an S corporation in year 3 as our numbers dictate that. So these are all important things to think about. It's not a static decision. That's really what I want to get across.
Yeah, and I want you raise a really good point. I want to talk about, to just follow up on LLCs taxed as S corps versus an S corp, and Massachusetts has sort of a minimum entity tax for LLCs taxed as S corps or S corporations. So we need to be reminded that there's always going to be a tax ramifications. But from the point of view of, I get these questions a lot. Why can't we just be an S corp versus an LLC? And I said, well, yeah, you could be an S taxed as an S corp and be an LLC. And so don't be so married to the idea that an S corp has to be taxed one way and it's rigidly a corporation. Because if you are a person who owns a large business, you may not want to be an S corp, because you may not want to be observing a lot of the corporate formalities and putting yourself out there as far as your liability. So the LLC gives you a lot of leeway, both from on the taxation side and from the governing side of the business.
Yep, that's a great point, right? And I just want to stress, and I know this is a lot of high level talk, there are different issues, like Sylvia's saying, with S corporations, only certain people can own them. You're limited to the number of shareholders, right? LLCs,
can't be a foreign corporation.
Right. There's a lot more flexibility. So I don't want you to think we're trying to cover it all. I just I think the important takeaway is there's a discussion to be had. And like the answer to every tax question is it depends, right? And why every accountant says it depends on your situation, right? Not necessarily mine. Sylvia is different than me, who's different than you, who's different than the next person, et cetera, et cetera. So I think the important part is it's important to have the discussion. And part of these issues become is I can't every year pick my entity conceptually, right? Because a lot of these things you have to do ahead of time. You've got to make elections to become S corporations, et cetera, et cetera. So it's not something you can decide on December 12th. Hey, I want to be an S corporation for 2021. It doesn't work that way. There's a lot of forward planning and a lot of decision making that has to go in ahead of time, right? So there are times with as your business goes up and down, maybe you're not exactly in the right spot, but it's not like you're giving away the farm. I think this is more of a longer term where if my company is going to a different level and my income's going to a different level, it's a great time to examine what tax structure I am, or if you've never examined it, to at least to give it the once over. I really think that's important.
I think that this educational webinar or podcast is an opportunity for any business owner to see that planning is very important as far as your tax liability and also as far as your legal liability and as far as your growth. So yeah, it's important to refer to your business attorney and your accountant and make sure that you have well-drafted documents, but consider all of the different tax ramifications from year to year, depending on what that law is. And oftentimes, right, Matt, in year one, there will be one ramification in a tax. And then in year two, we're going to we're going to raise it up a little bit, right?
Absolutely.
And so from one year to another, it may change. So it's very important to have these relationships with your accountants who are updated as to what the law is, and your business planning attorney as well. Now,
Sylvia, I just want to give you one more thing. I'm sorry. On
Yeah,
S corporations, I'm going to give you very quickly. The other reason why a lot of people choose S corporations is I become technically an employee and I put myself on the payroll, right? So this is a huge issue, and
Yes.
I'll tell you why. Right? If you're a partnership or a sole proprietor and I make $100,000, that means I've got to save somewhere in the neighborhood of $30,000 in tax. What happens is a lot of people are so busy taking that money and reinvesting into the corporation, or they're spending it for whatever their reasons happen to be. At the end of the year, then they don't have the tax to pay, or they're not paying their quarterly estimated tax payment. They get into trouble with the IRS. So the other non-tax reason that there's a reason to set up S corporations are when I set myself up on the payroll, and we do this for people, then I have them pay their withholding to cover their W-2 in whatever their potential K-1 is. They pay that in every 2 weeks, or every time they have a payroll, they're paying it into the government. So at the end of the year, we've paid their tax and they're not sitting on a giant tax bill. And it's also an easier way for business owners to say, hey, I get a net check every 2 weeks of $3,000. So I know I have to live on the home front on $6,000 a month, or whatever the number happens to be, right? So it really helps a lot of business owners who are new at this to help them kind of structure their cash flows on the home front, so they're not getting in trouble with the IRS. It's really a big planning issue for that as well.
It is a big planning issue, and so this is actually touches on one of the biggest issues, which is access to capital. And many clients will let that money sit in the account and work it as a capital account because of access to capital. And I think both your accountant and your attorney will be able to help you access that capital so that you're not spending your tax money that you'll be taxed on, where it's going to double your interest rate.
I know.
when you have to owe the money later. And it's a very, very common issue.
Yeah.
So finally, on this last line, we're just going to cover it very quickly because I'm sure that Matt and I will be having more talks. But we talk about exiting and selling your business, and also bringing in shareholders. So if you're a sole proprietor, you're the one doing work. And unless you have some intellectual property to your business or goodwill, you won't be able to sell it to anyone. So if you're a sole proprietor and you're in that category where you want to sell your business, you want to go and talk to your accountant, your attorney, and try to plan for that, because that's going to be very, very difficult for you to sell. It's same thing with the partnership. And again, it goes with dispute, whether you sell your shares to each other or your partnership share to each other. And some of that, or one of you is something terrible happens to you, one of you dies, you're going to end up in probate court. So that's where insurance comes in, so that one partner can buy from another partner and buy out that partner, so you don't end up in probate court. Again, that's very important as far as your LLCs and LLPs in your agreements, not so much in the S Corp. In the S Corp and C Corp, if the shareholder dies, the shareholder has that. It does not rock the entire world of the company. And we'll have more conversations about this going forward in the future. But that is your basic corporate form mini lesson. Oh, gee, we could have taught this, in a community college or a university.
No doubt that was a lot of information and not a long time, it felt like.
Well, I hope you have had an opportunity to digest it. And if you would like to get in touch with Matt Tarini, he is at MMNT. I'm going to put his contact information in the notes here on this YouTube. Thanks, Matt. We'll
Thank you.
do this again.
That was awesome. Thank you so much, Sylvia.
Bye-bye.
Bye-bye.